And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Nothing ever works in the studio anymore. So this morning, we're going to be kind of winging it just a bit to get through today's morning commentary. But nonetheless, we'll get you there. So first of all, markets rallied a bit yesterday. And again, kind of not surprising, as we talked about yesterday, the market was a little bit oversold here on a real short-term basis. So a bounce was likely. And of course, looking for that bounce back up towards that 20-day moving average. And as we said yesterday, that's kind of the key resistance. So this morning, futures pointing a little bit lower. Again, not surprising. We've got CPI data out tomorrow. Now, of course, this is going to be the next look at the inflation data before the Federal Reserve has their Jackson Hole, Wyoming kind of Fed speech. Every year we have the Jackson Hole Summit, which is this kind of economic forum of all the central bankers in the world and major bankers, et cetera, all come together to talk about policy and direction of economies and those type of things. So this is going to be the look at inflation before we go into that Jackson Hole Summit. Now, again, the Federal Reserve just hiked rates back here in this month, in July. And, that was kind of an expectation that maybe they would hike rates and this will be it. But tomorrow we'll get this inflation data. Expectations, of course, are that inflation will continue to weaken, but there is some risk here that we could see a small uptick in inflation. Energy prices have been on the rise, et cetera. Automobile prices have picked up here just a bit. And something we'll talk about today is that economic data may actually be at that point in the cycle that we may see a turn in some of that economic data. Strengthening the economic data would also lead to higher rates of inflation. So the question becomes, really, is the Fed done at this point? And I don't know the answer, but odds are that we may see here over the next few months a small uptick in inflation that could worry the markets here a bit. So again, we'll get that inflation data tomorrow. But again, markets a little bit soft this morning in anticipation of what that reading may be. Of course, a reading that comes in higher than expected may certainly weigh on markets further tomorrow. And on the assumption that if inflation is starting to tick up here, the Fed's going to have to remain aggressive. And obviously with the markets very detached from real rates. Now, again, we touched on this yesterday a bit. If you take a look at the NASDAQ in particular, those type of companies that are dependent on high growth, they need lower interest rates and lower inflation in order to support that earnings growth, especially when you have companies trading at 10, 20, 30 times price to sales. Those really are dependent upon very strong economic growth. So for the rate hikes, of course, and this is why if you take a look at longer duration assets, growth companies as an example that need long runways for growing earnings to catch up with valuations, that's why there's a high correlation historically to real interest rates. So if inflation is beginning to tick back up, that may not be so good for growth or durational assets like growth stocks. And again, there's a big detachment right now this year in particular because of this big surge in just a handful of these big growth mega cap names. There's this detachment from the index versus real rates. And again, so at some point that's going to have to catch up. Either real rates are going to have to reverse and catch up with stocks, which would be a very sharp drop in inflation and a drop in interest rates, or you're going to have prices catch down, or a combination of both. And of course, probably the combination of both is the most likely outcome, and that would be coincident with the onset of a recession, whatever that is. Now, speaking of recession, there is no expectation of one right now. So remember this time last year, everybody was expecting a recession. Now nobody expects a recession, which ironically is about typical of what you would expect. If we go back and look at the last three recessions in particular, recession expectations dropped markedly before the recession actually set in. Again, when the market kind of expects something to happen, that's generally when it doesn't. When the market doesn't expect it to happen, that's generally when it does. It's just basically markets pricing in expectations. But again, most of the time the herd is wrong, at turning points. And so again, as we get into next year, the question is going to be, will we see that recession? Will we see that economic slowdown? Some of the economic data certainly suggest that, leading economic indicators, et cetera, certainly suggest that we should see an economic slowdown. But again, we've had this data negative for such a long time now. The question is, will it begin to turn? Okay, with that said, we'll get into that this morning. No, here's what you need to know before the bell this morning. Again, as I said yesterday, the markets were very oversold, looking for that challenge to the 20-day moving average. That occurred yesterday. Nice rally during the day. Markets finished up pushing right into that 20-day moving average. This morning, markets are going to open lower. So this will technically be a failure of that test of that 20-day moving average. And as we've talked about over the last couple of days, such a failure would certainly suggest a lower low for the markets, at least in the near term, coming down to test that 50-day moving average, currently sitting right around 4,400. So again, not a deep decline here, but the MACD sell signal still firmly intact here at a fairly elevated level, suggesting that we do have some more work to do price-wise in the normal kind of oscillation of that indicator. Relative strength did pick up just a little bit yesterday, but again, it's still oversold. So again, you're not looking for an immediate sell-off. We just don't have that type of panic in the markets right now. Kind of more this gyration. In fact, we could see the markets just kind of trend sideways here for a couple of weeks, allowing these moving averages to catch up to the market itself. Certainly that's not surprising. But again, we're kind of in that period right now where the markets are very elevated from longer term moving averages and need a bit of a breather here. So either a longer consolidation of price movement going nowhere, or we kind of get this pullback to the 50-day moving average. We see what we look like when we get there. But again, we really kind of need to work off some of these more overbought conditions that occurred from that rally over the last 5 months. We really just haven't done enough work here yet to really get the market into a good risk-reward entry point to add exposure a little bit more safely. We'll get there at some point. We're just not there yet. And again, these day-to-day movements really don't mean a whole lot. But again, what we're looking for here in particular is a technical failure or success of this initial level of support. So again, we took out that 20-day moving average a couple of days ago. We're now we tested it yesterday. If the markets can turn it around this morning and get back above the 20-day moving average, well, then we can retest the recent highs as well. So that would certainly suggest we're still kind of grinding higher here. But again, what we're looking for is that failure. And if we do take out a failure of this 20-day moving average, the market turns down and we take out this low from day before yesterday on Friday, take out Friday's low, that's going to definitely put the 50-day moving average as the next target for this decline. Again, nothing to be really concerned here. I mean, it's not, this isn't worth, selling big chunks of your portfolio to raise a bunch of cash. We're just going through a corrective movement in the markets. Very well expected. This is one of those things you kind of just ride out for right now and then take some of that extra cash you've got building up on your sideline to put that to work at, the 50-day moving average if we get there. And again, just because we get to the 50-day doesn't mean we can't go lower. Certainly risk down to 42.40 at the 100-day moving average as well. Certainly possible for just a near-term correction. And again, so, when we get to the 50, we'll reevaluate things. Are we sufficiently oversold? Have we reversed some of these overbought indications? Have we reversed some of these deviations from longer term moving averages? So we'll just analyze it as we get there. There's no need to, have a specific set time and date that I'm going to do this exactly when this happens. When we get there, we'll measure it, we'll look at it, and then we'll make the best judgment on risk reward about putting capital to work. But that's the plan right now, and that's what you need to know before the bell this morning. So coming back from the break, we'll talk about some of this economic data. Has it been negative for so long that it's likely to turn up here a bit? And that may actually confuse some of the more bearish prognostications out there. But we'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. So the markets have been doing very well this year so far. And again, you know, when you just go back to this time last year, everybody was extremely bearish. In fact, bearish sentiment was reaching some of its lowest levels that we've seen since the financial crisis. Everybody was convinced there was going to be a recession. And since then, markets have been performing much better. Obviously, the rally since October has continued, and particularly over the last 5 months, it's accelerated. And we've seen a much better turnout for markets this year than what most anybody expected to occur. Now, that's the way markets tend to operate historically, and they tend to do things that you don't expect them to do. And that's how things happen. So one of the important things to look at, of course, is that markets tend to lead the economy by about 6 to 9 months. And we hear this often. And the reason for that is because markets are starting to, when you're going through a period of time, markets get exceedingly bearish, like we saw. And then they go, well, things are pretty bad here. So, things are probably going to start getting better. And so they kind of start pricing in better times ahead from low points. And same thing occurs when you get near, very elevated peaks in markets. And so if one way to measure that, and again, this is why markets ebb and flow over time, right? There's a cycle to markets. And so if we take a look at this chart of the S&P 500, and it's just the annual rate of change in the S&P 500. Now, importantly about this, this chart is, and we're going to kind of reflect back on this a couple of times as we have this conversation, is that these cycles tend to occur over time, right? And so when you think about the markets, it's clear that, not everything just goes in a straight line. Bull markets don't last forever. Bear markets don't last forever. Things ebb and flow. And so we take a look back at the S&P 500. This is, again, it's just the annual rate of change in the index. And what's clear is that while it seems like markets just go higher, they really don't. There's this ebb and flow to markets on an annual basis. And we see these cycles. And you'll notice that, not surprisingly, since October of last year, we had gotten fairly, the down cycle in 2022 got us fairly oversold to the bottom of that normal kind of cyclical range of the markets. And markets have turned higher. Now, there's obviously clearly still more to go on the upside just to have a kind of a normal cycle, right? Think about this like an oscillator, right? And it's going to oscillate up and down. And so we're coming off these recent lows. And because we're coming off these recent lows, expectations are that we should begin to see some improvement really kind of across the board. So again, though, however, to have this improvement, right, we need earnings to continue to improve, which means that given that earnings are a function of revenue or come from revenue, where then revenue comes from economic activity, we're going to start to need to see economic activity improving, right? So this brings into question this whole analysis of, the economy and earnings and these type of things. And again, if we take a look at market cycles, there's a clear correlation to earnings growth, right? And that's also not surprising, right? So again, if the markets are expecting better outcomes, right? Investors are starting to bet on a turn higher in earnings, et cetera, and that means a turn higher in economic activity. Well, then we should see a correlation between earnings, the annual rate of change in earnings, and the annual rate of change in markets, and it's exactly what we see. Earnings have not turned up yet. So the second quarter, the annual rate of change of the S&P 500 is still declining. But expectations are this is now the trough of that year-over-year rate of change in earnings, and we're going to start to see that improve. And that would be logical because the market is improving. And so as the market improves, markets are improving based on expectations of increased earnings. So earnings should start to improve in theory, right? In theory. And there's certainly some points in history where there's been short-term deviations and things haven't occurred as you would have expected. But this is what market cycles are telling us right now, is that we should start to see an improvement in those earnings. And again, in order to have an improvement in earnings, we need to also see an improvement in economic activity because that's where revenue comes from. And so if we take a look back in history and we take a look at the leading economic index and we look at the 6-month rate of change of that's been a very good leading indicator of economic recessions, et cetera. And we also take a look at our economic composite index. Now, our economic composite index, which is the black line I'm showing you in this chart, but don't worry about it if you're driving. I'll explain to you. The important thing about this economic index is that it contains over 100 different data points of both soft and hard activity in the economy, service and manufacturing, hard and soft data, leading and lagging indicators. It's a very broad measure of the overall economy. And not surprisingly, it has a very high correlation to economic activity. Now, importantly about this chart is that you'll notice that we are at some of the lower levels of periods of economic activity outside of extraordinarily critical event markets, right? We obviously had a much deeper negative drag during the financial crisis. When we shut down the economy in 2020, not surprising, we had a much deeper drag of this economic data. But in a normal kind of economic environment that is devoid of a crisis of some sort, we are at a very low level of economic slowdown and economic activity according to all these indicators. Now, what that suggests is that we've been negative now for such a long period of time. Just by the sheer nature of how economic cycles work, we should start to see some economic improvement in this data. In other words, things have been negative for so long, it doesn't take much to see some improvement. And it can still be negative data, it's just not as negative, and so it will start to improve. In other words, if we have an index that was negative 10 last month, but negative 9 this month, and negative 8 the next month, it's still negative, right? But it's improving. And if you have improving economic data, that should feed back into, theoretically, improving earnings data. Because again, you're measuring this on a year-over-year rate of change. So again, if earnings are negative $1, then negative 90 cents, then negative 80 cents, it's improving. It's just still negative, right? And so if we take that economic composite, which is that 100 data points of hard and soft manufacturing activity, and we overlay earnings with it, not surprisingly, we see that same correlation of activity, right? So as the economic data improves, even from low levels, you should start to see a turn in economic and earnings activity, right? Earnings improvement. If you get a turn in earnings improvement, that supports market prices. So again, the economic data is what will drive the earnings improvement. And we're, again, if we take a look at this kind of cyclical rotation of markets, it suggests that we've been negative long enough now that we're going to start to see some improvement. And that improvement, obviously, and one reason the markets are doing well right now is coming from the sheer fact that we've had a massive surge in government stimulus. While GDP has been slowing, we've had this massive increase in the fiscal stimulus applied to the economy, which has been supporting a lot of this economic activity so far. And with this recent passage of the debt ceiling bill that increases government spending even more, certainly doesn't suggest that we're going to see a slowdown in that fiscal support to the economy anytime soon. So again, if this fiscal spending starts to relate to stronger economic activity, it's going to start to suggest, at least at this point, that we should see an improvement, a continued improvement in earnings, which would help support this recent run in prices. Now, look, I'm not saying that this is all just fine and dandy and we're off to the races and, everything's good. What we're talking about is economic cycles. And again, negative 10, negative 9, negative 8, still negative growth, right? But it's just improving negative economic growth. And that's what the markets are betting on, is markets are betting on improvement. But earnings estimates are still extremely elevated. Going out to 2024, analysts are expecting a growth rate in earnings that remains historically unsustainable. We're going to have to see those come down. Because you're growing at a pace, or the estimates are at least, of earnings are growing at a pace that far exceeds what economic activity is. So even if you're seeing some improving economic activity, it certainly suggests that the upside cap to stock price appreciation is probably limited here. Because again, there has to be some relationship between organic economic activity and what's happening with earnings. And we're really deviated above that. And right now we've got the markets have been starting to correct here lately, and that's not surprising because we've got a fairly big deviation above the 50-day moving average. So again, this is what we're talking about. The markets need to correct back towards or potentially below that 50-day moving average, which is completely normal in any given cycle. And of course, we look at our technical composites that we publish in our newsletter every week. Those are extremely overbought. They started to correct here a little bit last week, but they're still at very elevated levels. And most importantly, bullish sentiment is still extremely bullish. So again, markets have gotten well ahead of the turn in the economic cycle, but markets are anticipating this turn in the economic cycle. Still a lot of work we got to go through, but importantly, we've got to be looking at the impact that there's still a lot of people expecting very negative outcomes over the course of the next 12 to 18 to 24 months. And you've got to remember that markets and economics cycle. And we're at the point that we may begin moving into an upcycle in some of that data, which may temper some of that more negative outlook. Okay, quick break. We'll come back, talk some more about the markets and the economy. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So last night I wasn't sleeping well, so I got up and went into the living room, just kind of laid down on the couch for a little bit. And she always leaves a light on in the front of the house.
The Real Investment Show podcast. Same show, your schedule.
This morning my wife is up. She's like, honey, did you know that the lamp was off in the living room? Why is it off? Did somebody break in last night? I said, yes, honey, a climate activist broke in last night and turned our lamp off.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So here's the important thing to take away from, and it's interesting because, I wrote that article that's on the website this morning talking about market cycles. I wrote that on Saturday. And of course the market started to correct yesterday. So, the point is that, markets are performing better. You have to give credit where credit is due. And yes, there's certainly lots of reasons to remain negative about a lot of things, right? Certainly a lot of concerns out there relative to the economy and where we go to from, could we have a recession or not? Absolutely, recession's possible. The one thing we kind of have to remember is we just had a recession. Yeah, the recession was a function of an economic shutdown, but we just had a recession. And throughout history, there's not too many occasions where you have recessions within just a couple of years of each other. So that's also one thing to kind of keep in mind, and one of the reasons why it's possible that we could avoid a recession. But again, we go back to, the Fed's hiking rates. They're trying to slow things down. We're trying to get, unemployment, rates up a bit here and slow down inflation. So that's all certainly the ingredients that you need for a recession. And so the question is, will we get one or not? And I don't know the answer. Maybe yes, maybe no, but it is what it is. But I think we have to also just remember that markets do tend to ebb and flow. And markets are pretty good at anticipating economic recoveries, and which is what the market's been doing. Now, it's gotten ahead of itself. This whole AI chase, et cetera, has gotten well ahead of itself. And so, again, this is why, I note in the article that a correction is likely along the way, and we're probably going through that correctional process now. Everybody's very excited. Everybody's very bullish right now. So, going to have some type of a correction here, whether it's now or a couple of weeks from now, a couple of months from now. We're likely to have a 3%, 5%, 7% pullback, right? That certainly wouldn't be surprising. But such would likely, again, kind of provide that setup for another rally as markets continue to anticipate a turn in the economic cycle. And if you do start to see earnings improve, if you do start to see economic cycles improve, some of this economic data improve, that will support the bullish case. So my whole point is just simply, you can't just ignore that data that's out there. But there's certainly a lot of risk, and there's a lot of concerns that are going on. But the one thing that we also need to pay attention to is that we are moving into an election year. And nobody wants to go into a election year with the economy in a recession because it's a guaranteed lose. Go into an election cycle with a recession, you're going to lose the election. That's just kind of history. So there's going to be a lot of support, kind of stealth stimulus, so to speak, of government spending, et cetera, to try to keep the economy moving along here until we get to the election. And this goes for both sides, right? I mean, there's really kind of both sides here that have, if you're running for Congress, you don't want to be in a recession, going into an election for Congress. So there's a lot of incentive on both sides to make sure the economy kind of chugs along through 2024, get us past the election. Then you can have your recession. Have your recession, but after the election, not before the election. So, this is, that federal spending is the one thing to kind of keep a watch on, because it has increased sharply, and that's the one thing that you kind of scratch your head and you go, well, I just don't understand why the economy is just doing this and why companies are doing that. You have all this other data out there that's just super negative, and I just don't get it. Well, there's a reason. But it's also important to understand that markets just cycle over time, and just in a normal, if you just kind of think about the economy as one person just for a moment. During a recession, right? That person cuts back on everything. I'm worried about my job. I'm worried about losing my job. I'm worried about this. I'm worried about that. So I'm going to cut back on my spending. And that's why you have a recession. But at some point, you've just cut back so much that you've got to go buy something, right? You eventually have to go buy groceries, right? You eventually have to go buy something, right? And so when that restocking cycle begins to occur within the economy, you can begin to see that pickup in activity. And that's why markets cycle and economics cycle, because you go through these stages where you're destocking or restocking. And we've gone through a destocking process now for the last year. And so we're just getting to the point now that you're going to start seeing some positive turns in some of this economic data. It's just the way the math works. Kind of like, we talked about with CPI, year-over-year changes. These year-over-year changes are going to start to show some improvement just because they've been negative for so long. It's just a function of math. But this is going to be the thing that we're going to have to factor in. And this is going to be the conundrum. It's like, well, how can this be happening when the Fed's doing this and this is happening, and, commercial real estate and this, the article this morning about commercial real estate. Baltimore Sun editorial board tells everyone to keep calm. Commercial real estate in Baltimore is crumbling, mostly due to their crime wave downtown, but it's also due to the work from home situation. Companies are downsizing, moving out of the city, etc. But this is happening all across the country. Baltimore's just the latest headline. But we're seeing that same problem with commercial real estate across the country. Work from home, need less space. Companies are moving locations, signing less leases, or not renewing their leases. So it's a problem. A lot of commercial real estate was built dependent on this whole work from office environment. That's changing. Maybe for the better, maybe for the worse. We'll see. But that's certainly those indications, right? Automobiles. Everybody was going out. They had stimulus checks. They went out, bought autos. They drove auto prices through the roof. Now interest rates are much higher. The ability to refinance a car is much tougher. And, of course, now a lot of people just bought cars recently, so they don't need a new car, and they've got a lot of negative equity in that car, so it's going to be hard to turn it in, right? Trade it in. So there's certainly issues in the automobile sector. There's certainly issues in the real estate sector. Housing's still a problem right now. Just affordability. It was very interesting. Saw some analysis yesterday talking about the housing market. It's a good example. In 1995, it cost about 31% of a person's income to buy a house. In 2020, right, just before the pandemic shutdown, it cost 21% of a person's income to buy a house. And that was, and yes, housing prices increased from 1995 to 2020, right? So 25 years. Prices basically doubled on home prices. But because interest rates had fallen, the amount of income needed to pay for that house was only about 21% of incomes. Between 2020 and 2023, house prices doubled again, and is now 49% of a person's income to buy the house because of where interest rates are. But all that stimulus that we shoved into the economy created this explosion in home prices that has now created this unaffordability problem for individuals to buy a house. Now, that'll eventually reverse itself, right? Supply and demand over time. So this will eventually work itself out, but it's going to take some time. But this is going to be another drag on the economy. There is a contribution factor from housing in the economy, and so if people can't afford to buy houses, that's going to take away from that contribution to the economy. So there's certainly, the point here is there's certainly a lot of things to be concerned about with the economy. But it doesn't mean that you can't see an improvement in the activity, right? And again, it's going to cycle. You're going to have this uptick in the economic cycle, and it's going to downturn again. And you could go through a period where these oscillations are fairly quick, 1 year to the next type thing. And this is why I've been talking about, this idea of a recession. Can we have a recession? Certainly, there's certainly the catalyst there to have a recession, but it may not be in 2023, might not be in 2024. Could be 2025 before we see the next recession. Because you've got to kind of have an increase in that cycle of economic activity. It pops back up, and that sets you up for that recessionary downturn. We'll see. I don't know. I don't have the answers. All I'm trying to do is just work through this data. But again, this is kind of what markets are predicting. But again, there's certainly concerns about the economy. UPS this morning reporting earnings, missing on a lot of fronts. Suggests a slowdown in consumer activity. Yellow Freight going out of business. That's other problems other than just the economy. But again, certainly suggests there's problems within the economy. Can't dismiss any of that. Anyway, we'll come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. Beyond Meat, fake meat company, down 14% this morning on fake earnings. No, I'm just just joking. just joking. Beyond Meat revenue falls as people don't want to eat fake meat. I mean, just so many jokes here. Yeah. Anyway. If we ever get into a pandemic again, one thing you will know there will be in a store is fake meat. The Beyond Meat shelves were stacked. You couldn't find anything else, but you could get plenty of Beyond Meat. Anyway, earnings out this morning. We already talked about UPS and Beyond Meat. UPS down sharply this morning, missing revenue forecast. Eli Lilly, Twilio, Bumble, which is the dating application. Rivian, the electric car company, Capri Holdings, AMC Entertainment, of course. Everybody's kind of watching AMC. AMC's up 32% this year so far. Still down 78% from last year, but it's up 32% this year, so pick your poison. But everybody's hoping that Barbenheimer will help save some of the theaters, that people will start going back to the theater, again in droves. And, it's very interesting when we shut down the theaters were doing pretty well on average pre-2020, really and pre-2019 when, Disney actually made good movies. And really ever since the pandemic and this whole shift of focus and political infighting, et cetera, nobody goes to the theaters anymore. And theater attendance has just dropped markedly. So again, whether or not these theaters can survive long term without people going back to the theater is going to be a challenge. And again, now with more and more people, and again, this is also the problem with streaming services as well. If I just wait, I can, rent Barbie or Oppenheimer pretty soon. It'll be on my pay-per-view and I can, buy it for $19.95 or wait a little bit longer and I can rent it for $7.95 or $5.95 or whatever the rental rate is. And, when you start thinking about, well, I'm going to go to the movie, this is also the problem with the theaters, is it's great to go to the theater. It's fun, get out of the house, go do something. But, excuse me, but by the time you spend, you and your wife and a couple of kids, right? You go to buy the tickets. So you're pretty much in $50 on tickets and then another $490 on, popcorn and Coke, whatever you're going to get for concessions, then go watch the movie. Spending $19.95 to buy it and watch it at home is certainly much more affordable, particularly in a economic softening, right? So, does AMC get their mojo back at some point and, people start going back to theaters, getting out? I don't know. Maybe shutting down the economy has changed the consumption habit of movies and people are going, I really don't need to go to the movie. I can just buy it and watch it at home. I don't know. I don't have the answer to that, but it is interesting. I mean, like you can literally take a look at movie theater attendance. It was actually rising into 2019 and then just fell off a cliff and never came back in 2020. Restaurant brands Novavax this morning, Under Armour, the overly expensive athletic wear, will be reporting earnings, right? Warner Music Group, Lee Auto, another electric car company, Fox Corp, Celsius, Blink Charging. Of course, they are the charging stations for electric cars. Duolingo and Dutch Brothers Coffee Company. We were talking about Starbucks the other day. Dutch Brothers makes actually very good coffee, right? But they don't have the cachet of Starbucks. Nobody goes around and goes, hey, you want to go to Starbucks? Nobody says that, right? You go, hey, want to go get a Starbucks? And you go get Dutch Brothers or Black Rifle Coffee or whatever other, chain is out there, right? It's just we've adopted this, Starbucks created this cachet around drinking coffee. Well, actually, Starbucks created this cachet of drinking overpriced coffee. That's what they did, and they did it very well. So, we'll see. Economic data this week, of course, tomorrow is the much anticipated CPI report. So we'll be taking a look at that very closely. Expectations are that we'll continue to see a little bit of weakness there, right? This continued decline towards 2% is the hope. One of the driving factors of that inflation number is going to be housing, which runs a big lag effect, and housing prices are coming down. So we'll see if that feeds into this economic data. The core inflation, of course, is what the Fed looks at, and not just CPI core, but they also look at PCE, the core PCE, which is the personal consumption expenditure inflation index. They take a look at that also. Is that coming down? So we'll see. Well, we'll take a look at those core numbers because that's really what's going to be driving Fed decisions here, particularly as we move into the Jackson, as I said earlier in the show, this Jackson Hole Summit meeting coming up, which is going to be the next opportunity for the Fed to really kind of state their case as to their position on monetary policy. The markets are definitely hoping for a pivot in interest rates to start cutting interest rates and start going back to, kind of this Fed liquidity program. But the Fed's been pretty adamant they're not going to do that until they see inflation, back down towards 2%. And they're not going to really start doing QE until there's a problem economically. Till you get that recession, whenever it occurs, or a concern about it. The problem that we have right now with rising interest rates is, and this is an article I'm working on now, there's, people talking about, again, interest rates have to go to 5 or 6% because of all the debt we're issuing, et cetera. And that's certainly logical in a market that is driven solely by buyers and sellers. However, what that analysis neglects is the impact of higher interest rates on a highly leveraged economy, which we have, $32 trillion just in government debt, not to mention all the consumer, corporate, et cetera debt. But when you're talking about an economy that's leveraged 5 to 1, and a lot of that leverage is based on very low interest rates, there is a point to where if the buyers of bonds go, I'm not buying it until I get a higher rate because of the risk, the Fed's going to step in and monetize that debt. They're going to force rates lower because they have to. The CBO just recently came out and talked about their debt projections to 2053. What that analysis neglects is that the Fed will have to monetize about 30% of that to keep interest rates at a normalized level. So again, it's just a function that we're slowly heading down that pathway to Japan, which is where like the Bank of Japan, which owns 80% of the bond market in Japan, there'll eventually be the case that the Federal Reserve owns a very big chunk of the bond market in the U.S. to keep interest rates low, because you have to. The economy can't really sustain 4% interest rates on the 10-year Treasury, and it certainly can't sustain 5 or 6. The housing market is struggling at 7% mortgage rates. It is going to be a death knell at 8, 9, or 10% mortgage rates because the economy is based upon low interest rates. We have leveraged the economy based on low interest rates. The economic growth that we've had has been a function of low interest rates. The economic growth we've had has been a function of increases in the debt. You can't reverse that without having a significant economic downturn and contraction, kind of on the level of what we saw during the Great Depression. Now, if you think the Federal Reserve is going to stand for a depressionary economy, then you're probably mistaken. But that's what we've got to deal with going forward. The new normal is that the Fed is going to own more and more and more of the bond market over time, not because they want to, but because they have to. No president is going to want to preside over a depressionary economy. So the Fed will do their job. The Treasury will do their job. Because no president and no Congress is going to want to cut spending. They certainly don't want to cut spending to social welfare programs. And again, this is the gray rhino theory. Michelle Wucker, she wrote a book back in 2016 called The Gray Rhino. The premise of the gray rhino was, don't worry about black swan events. Black swan events occur, but those are one-off anomalies. The thing you need to worry about is the gray rhino, which is this inevitable outcome of debt. And at some point, the markets solve that problem for you if you're not willing to take care of it yourself. And that's the problem of debt. And again, it's not tomorrow. It's probably not next year. It's probably not 10 years from now, right? Look at Japan. They've been going along here for 30 or 40 years, still kind of stumbling along, right? Still doing all right. But eventually, we'll see what happens. But what we do get from that, of course, is slower economic growth, lower inflation, less economic prosperity, but lower interest rates also. Just keep that in mind. All right, that wraps up the show for the day. We'll be back tomorrow. Danny Ratliff will join me, and we'll pick up on the markets, see what happens today. NASDAQ down about 120 points right now pre-market. Dow's down about 250. So, again, we'll see if the market can recover and kind of keep, get itself back above the 20-day moving average, or do we take out Friday's lows and look for a retest of the 50-day moving average, which right now seems more possible. But we'll talk about that tomorrow on the next edition of The Real Investment Show. Have a great day. See you back then.